Okay, good morning to everybody, and we're going to get started. And I apologize for the couple minute delay in getting started here. Actually, I locked myself out of the room for some reason. I don't know how I did that. I had my passcode; it wouldn't work, and it gets me a little panicky. But I think I probably hit it too many times and had to reset. So anyway, we're going to start with week 12 today, and we're pretty much really right on track with where we ought to be at this point in the semester. So, which is kind of good. I know at the beginning of the semester, I always do my best to sort of plan as to where we'll try to be with regard to the chapter readings that I want to cover and the material within that. And so we're in pretty good shape. Doesn't look like we'll have to cut any material necessarily. Before I go over this, a couple of brief things I want to talk about. The third exam was last week and was available through Sunday evening. So if anybody had any difficulty with it, yesterday was a really crazy day. I had meetings in the morning and then class in the afternoon and night. So honestly, I haven't seen email since say Sunday. So if you had any difficulties with the exam and you have not contacted me yet, please do so. We'll work it out. Whatever the issue is, we'll try to deal with. But I haven't. If you email me either very late Sunday, or anytime during the day yesterday, I just haven't gotten to them. But I have my office hour right after this class, and I'll go check the email and get back to you on that. Okay. All right. So, and remember those first four exams, the lowest of those scores is dropped. So, and that'll the computer will do that automatically. I just want to make sure that everybody's familiar with what that whole process is about. Basically, it zeroes out the lowest score, which means that if you missed an exam for whatever reason and chose not to make it up, then it'll automatically default to 0. And it just won't count anyway. So there's no big deal there. And nor, so it takes it out of the numerator and the denominator in terms of calculating the final score. So it works to your advantage to do that. You are allowed to take makeups of exams, like exam 3, you have this week to do it. If you didn't do it, you can make it up. I can make it available for you. The same goes with exam 4 as well. So the final exam, there's really no chance to do a makeup. And I haven't really talked about the final exam yet. We'll talk more about that as we get a bit closer, and I can give you a little bit more details as to what to expect for that. It'll be slightly different, but not very much, okay? Than the first 4 exams you've seen up to this point. Okay, so that's one thing. The second thing we should talk about is the fact last week I sent out an extra credit activity for you to do, and it kind of arrived sort of unceremoniously without much fanfare. And what it is about, and that's sort of how it arrives on our doorstep as well. Every couple of years, 2 or 3, I guess 2 years maybe, the school takes individuals, the college as a whole, takes individual schools and does what's called assessment operations. It's an internal sort of study just to find out what students are learning, what the impact of the learning is, how they're able to put logical thinking together in terms of the content. And so some exercises developed in order to sort of assess that. It doesn't impact your final grade at all. So so if you feel like you don't want to do it because it's going to mess up your final grade, don't think that at all. It can only help your final grade because there are 20 extra points possible. If that doesn't sound like very much, consider there are only 400 points possible in the course. So it's about 5%. It's about half a letter grade. So you might want to consider doing it. The activity itself, and I didn't write that. It's the team that was the assessment team wrote that. It talks about 75 minutes. You have 75 minutes to do it. Well, that's the length of a class session. The anticipation is it would be given out during a class period, but obviously we know most students are taking this either remotely or the live Zoom link or remotely by video. So obviously you can do that on your own. So if you want to do it, you've got till Thursday, midnight Thursday to do it. And just email me a copy so that I've got it. And I won't even look at it until after the trip is over. And then also upload it to I think it's Microsoft Links. There's a link provided there. You can upload it to that. The link does work, I'm told. So you shouldn't have any difficulty there. So you got till that Thursday. Just write a letter. It doesn't have to be perfect. I mean, I wouldn't stress over it too much, but it is asking you to advocate a position based upon what you know now about the study of economics. Now, never mind the fact that the question itself is moot. That is the soccer stadium, the proposed soccer stadium that was eventually turned down by the voters, but that's irrelevant as to whether or not it's a live issue or not, or it's a real thing. It was a real thing, but it's just the point is about applying logic and economic reasoning to your advocacy for or against, whatever your point is. It makes no difference what point of view you have on that. Okay. If you have questions about it, feel free to contact me. I'll be more than glad to talk to you about that. Okay. So those are some two items just to cover before we move on here. Today we're going to be, well, this week we're going to be spending time on chapters 14 and 15, which really could sort of go together. I like the way that the chapterization is made, though. We talk about banks and banking and financial institutions in chapter 14, and then we move on to central banking and the role of the Federal Reserve, who we've talked about intermittently in the class, particularly when we first introduced the idea of what's called stabilization policy. That is, how does the government try to, because it is the government that has the only responsibility, only the government has the responsibility for trying to keep an economy at full employment. If it falls short of or overshoots full employment, to sort of bring it back to that full employment level of GDP. And of those stabilization policies, one of the ones we talked about was monetary policy, which is what we're going to spend time covering on Thursday. If we don't get done with any part of that Thursday, we've got ample time next week. I've got next week blocked out to cover fiscal policy, which is the other part of stabilization policy that's done by government, but different actors. These are elected officials, Congress and the president. And I'm talking primarily about the federal government here, not so much state governments, even though, yes, we hear state governments getting involved in things like economic development and tax policy and, and incentives and all that. It's primarily going to be at the federal level that we're going to be discussing that. And certainly monetary policy is always a federal endeavor because states don't have their own money supply. So that's where we're heading. And that does it for all the content in the course. So we're getting pretty close to the period of wrap up. It's warming up outside and all that. We've all got the allergies to prove it. So we're moving forward here in week 14. We have the fourth exam. That's the last exam prior to the week 15, which is going to be here. It's going to be the 24th through probably the 26th for those who want to take it in bright space. And I'm assuming, just given my experience, our experience in the first three exams, that everybody will probably want to take it in bright space and rather than take it in class. But you are more than welcome to take it in class. You really are. And I don't want to discourage you one way or the other. If you want to take it in class, feel free to do so. Or you can also take it at one of the testing centers, at one of the campus testing centers, which may work for you if you want to do that as well. So whatever is your preference, that's what these attend anywhere classes were designed to do, is provide flexibility. And I think that we've certainly seen an example of that flexibility, not so much from the in-campus. I think a lot of us were expecting to have more in-class attendance, but it could be COVID related. A lot of people were reluctant to do that. Plus, I guess, why leave your house when you could, even if you are up and about at 9 o'clock on Tuesday and Thursday, why leave your house when you can watch this live? Or even better, why not watch it at 11 o'clock at night when you're kicking back and you can stop it, start it, save it, come back to it, whatever. So it's up to you. However, whatever works best in your schedule. So exam 4 will be available in 2 weeks, then the final exam, and I'll talk more about the final as to what to expect on that, and we can kind of go from there. Okay. And again, I apologize. I know I went several weeks in this class thinking that I could hear you because all the rooms, I've only been in a couple of the Attend Anywhere rooms. It's still fairly evolving technology. I can always hear because we've got these microphones here. And so that's how you hear me from these mics. But I can't hear you. And apparently, I have to turn the projector on, which is not going to work for what we're doing here. So it was too late to move rooms. So if you have a question for me in the live session, just send me a chat and I'll be I'll see it because it's right there. I can see that. This is why I'm always looking over there to see if there's something in the chat box, and if there is, I'll be more than glad to respond in real time for those who are on the live Zoom link. Okay, and for those who are not, this will be available probably sometime this evening. I just can't make it available sooner because of a class that comes in right after this. Okay. All right. So I think that does it. Are there questions for me for those who are on the live link at this point? Okay, well, if you do, feel free to shout out and let me know what your questions are. I'll be more than happy to talk about them. So let's talk about this chapter deal. Well, chapters 14 and 15 both deal really with something we've talked about intermittently, but we really haven't gotten in too much detail. But as you can imagine, this is an econ class, and so money is pretty important. And we really haven't talked very much about money, so let's do that. And I emailed the PowerPoint slide package for this week. It's pretty long because there's a lot to get to this week, and so there are quite a number of bits of content here. So I'm not going to push and rush to get through it. I'm just going to take it at the normal pace, but there is quite a lot. But it starts out with a slide that says, "What is money?" And that sounds like maybe a kind of a smart alecky question, because I think we all know what money is. But let's give an economist's definition that is a little bit more formal and more rigorous. It's what's called fiat, that is government issued currency. It's a non-metals backed currency. So when we talk about a fiat currency, fiat obviously is an Italian automobile brand, but fiat basically is government issue that something has value because the government says it has value. Our money is just pieces of paper, and it's not backed by gold, it's not backed by silver or any other precious metals, or it's not backed by anything else. It's just backed by the full faith and credit of the United States government. And sometimes people snicker at that, but in reality, the US government has far and away the world's highest stability and credit rating of any other entity, economic entity in the world today. And I know several years ago, US government debt was downgraded by the bond rating agency Standard & Poor's. The investor Warren Buffett had said how absurd that was, because if anything, it should have a higher rating, its own category of the highest rating possible. Because why? Because the US government can defend the value of its currency through management. So obviously, if we tell the people to go home tonight and pull out all of your monopoly money, that'll be as good as regular money, then we will have lost control of the money supply. Obviously, we're not doing that. We're also not dropping it from helicopters. So we're making it relatively scarce and relatively difficult to get, which in itself is a little bit misleading because of the fact that the government, through fiscal stimulus in the last couple of years, has provided us really with money from the sky in terms of stimulus money that most of us have gotten, advanced child tax credit money that a lot of us have gotten, expanded unemployment benefits, expanded Medicare benefits. So the government is really sort of pushing money out the door, but it has that unique ability to do it because it is fiat. Government can create it at will. And we're going to talk much more in chapter 15 about how the government can simply create money and do it sort of out of thin air. And it's money creation it's done by the Federal Reserve, but it's also done by the banking establishment, banking industry. And we'll see how it's a little bit easier than what you might think. And it's a little bit unbelievable, actually, in the way that money is created. So money is considered fiat. Now, one thing that surprises people, even today, is the fact that a lot of people believe that our money supply is backed by metal, like gold. And I know several years ago, there were some members of Congress who demanded to get into Fort Knox to make sure that all the gold was there. And they were convinced that somebody had made an offer like Goldfinger in the James Bond movie. So it's under control of the Army, and the Army is not exactly the most accommodating part of our government in order to let people trample through its facilities. But eventually they relented and let people come in, and their gold, it was all there. All the gold was there, but it was just gold reserves. It wasn't backing the money supply. It was just gold that the government owns and also takes in storage for other governments, because this is a safe place to put it. I don't think anybody believes the United States is going to be overthrown by foreign power anytime in the next several years or whatever. So we store a lot of gold for foreign countries. I know when the September 11th terrorist attacks happened, there was a lot of gold in the basement of the World Trade Center, and a lot of people were concerned about what's going to happen to that gold. They eventually got to it. It took a while, but they got to it. They were more concerned about recovering, the dead and all that, and obviously, but there was the Federal Reserve had gold stored below that. At least that's the story that we've been told. But obviously, you probably don't want to let a story out that there's a bunch of gold underneath a pile of rubble, but there in fact was. So it's not backed by gold. At various times it has been. When the US dollar was first originated, it was a mixture of gold and silver as backing for it, mostly because as a young country, nobody really had that much faith in the faith and credit of this fledgling United States government. Excuse me. And where governments don't have much credibility, they don't have very much credibility in terms of their currency. And so nobody really wants it as much. And we definitely saw this happening during some of the financial crises that happened in Latin American countries throughout the 80s and 90s, in particular in the 80s. I remember when I was in banking, and Mexico in particular had some real troubles with their currency and currency valuation. They needed some emergency loans from international lending institutions like the International Monetary Fund. And eventually Mexico did a very smart thing. They just pegged, they do what's called peg. They just linked the value of the peso, Mexican peso, to the US dollar, and that immediately stabilized the currency. The Mexican economy settled down and got back to its normal growth rate. And in reality, even though Mexico, on a per person, that is a per capita basis, is less affluent than the United States is, it is still one of the faster growing economies and has a relatively good standard of living, particularly in the urban areas. And so that was an example of stabilizing a currency that the world had sort of lost a little bit of confidence in. That was, and they were by no means the only country. Argentina has had multiple crises along these lines. Brazil, same type of situation. So it does happen. And it's what happens when you don't really have metals backing up. And the question is, why don't we have gold and silver backing up? And it really has to do with just sort of a practical reason. And that is the US went off of the gold standard most recently in 1971. And it did it unilaterally without talking to any allies. President Nixon just over a weekend decided we're going to de-link, I mean, I don't think he decided it, but it was his executive decision. The US was going to de-link from gold. And at first it was a bit of a panic, but everything settled down. Part of the rationale was the fact that as the economy grows, just organically through greater population, greater productivity, immigration, all those kinds of things, well, the economy is going to grow and the economy is going to need more money, and you're going to run out of gold in order to support that. And by the way, a lot of the gold in the world that has not yet been discovered is in parts of the world that are not particularly friendly to the United States or easily accessible. So it was important to de-link from gold and do that. So it's a metals back. It's another metals back currency. It's simply pieces of paper. And it's really not even that, to be real honest with you. Legal tender really is not even pieces of paper anymore. It's more entries in computers. And this is what has led a lot of people to worry about cyber attacks and the whole issue of bank technical security, because of the fact that you know, really the only thing you have to represent your money is not even pieces of paper. You can't even go to the bank. I mean, if you had $1 million on deposit at Wells Fargo, let's say, just to pick a bank, and walked in and said, I want my $1 million in cash. They don't have $1 million in cash there at that branch, most likely. My experience is, having worked in a lot of branches, they don't have anywhere near that amount of cash. And so they would probably direct you to somewhere else if you absolutely had to have the cash. And somebody would probably ask you some hard questions as to why you needed cash that quickly. Like, is there something that you're trying to pay a ransom or whatever? I mean, if you had the money in the deposit, they determined it was you, they would probably give it to you somehow, but maybe not very quickly. So it's not really there. It's not sitting there in pieces of paper. It's definitely not sitting in a bank vault with your name on it. It just goes into the general funding of a bank. And we're going to show some very rudimentary bank accounting here later to show how the process works. And we'll describe the process of turning deposits into bank reserves, turning them into loans, turning that into profit, okay? Which is what banks do in order to make a living, okay? So it's basically computer entries. And I certainly hope the banks and all the financial world has gotten their act together in terms of hardening their cyber capabilities, their defensive cyber capabilities from ransomware and hacker attacks, because that's all we really have. And in fact, a lot of us don't even get paper statements. We get PDFs. I get a PDF statement from my bank. I get a PDF 1099 tax form at the end of the year. You know, and so we don't even have paper statements to back it up. I try to save that stuff when I get it. I just save it on my computer. Let's hope that doesn't get hacked. I mean, but really, we were sort of at the mercy of these systems. And by the way, I did work at a bank once when we went a conversion. We were bought by another bank, and so we were converting to their systems, and it didn't go well, to say the least. At various points, people's accounts went to zero. Can you imagine how freaked out people were when they had $0 in their bank account and they were in an ATM and needed the cash right then and there? Oh, it was a miserable, miserable experience. And it took a couple of weeks to get it fixed in 2 or 3 weeks, 2 or 3 weeks. And we had employees quit because customers were just so livid and nasty. And you can't really blame them, but I mean, I remember I was just so tired. I said, I gotta go to lunch, I gotta leave. I went to lunch, and the same people who had yelled at me for an hour were there at the same place I was having lunch, and they came over and kept it up again for another 20 minutes. And it's like, oh my gosh. So it's a very emotional subject, money is. So we certainly hope that the cyber defenses are there, because there is nothing backing it up other than what their word for it. So if I were you, I would back up everything you got in terms of statements. If you get email statements, or if you get PDFs that you can get onto their website, I would save that stuff. I really would, just that you know what you've got. And I'm sure they would make good. I mean, banks are not in business of trying to disadvantage their customers. They're going to say, hey, you have no money. And we were never telling our customers that when our systems were offline. It was more, we will do our best to get you what is yours. That's that type of thing. Okay, so in terms of what money is, it's sometimes best to describe what it does. So I've spent a few minutes talking about money in terms of what it's not. It's not metals based. It's not there with your name on it, sitting in a bank vault. So let's talk about its uses. And these uses are going to translate over into both how we measure the money supply, as well as how we measure demand for money. Okay, and so we've got a number of different uses of money. And since I don't need the board, I'm going to swivel over here for just a bit until I need the board. This is kind of nice. And so let's talk about what the three, excuse me, these allergies are kicking in here. So let's talk about what the three uses of money are. And the first of these is something called a medium of exchange. And that is, and your text talks about this idea of solving the barter problem and the so-called double coincidence of warrants. So what money does in this function, this is really sort of the original uses of money. Now, when money was first created as pieces of paper, not metals-backed currency, but or even gold itself or silver, because those themselves have been used as money and tradable and whatnot. But when paper money first developed, it was basically a bank receipt that somebody would say, and a goldsmith in Europe in medieval times, where somebody would take gold and have it for safekeeping at a banker, and a banker would issue a receipt, and that receipt then could be tradable to others by saying, here, look, at this goldsmith, I've got this on deposit. And so that became the first use of paper money. And it was a medium of exchange because it facilitated transactions in the so-called real economy. That is, where we're buying goods and services. Otherwise, the only other means of exchange would be either with some metals-backed currency or metal itself, which is scarce by definition. And by the way, the reason why gold became sort of the de facto standard for a money supply, a very early money supply, all around the world, all throughout time, even going back to ancient times, is the fact that gold is scarce. And gold has some unique properties. It can't be burned up. You can melt it, but it'll go back to its original form. It can't evaporate. It can't rust. It can't be destroyed. It can't be, I mean, I don't know if a nuclear weapon would even destroy it. It retains its character. And if you look at like King Tut's tomb and the gold, you know, the gold, whatever it is that King Tut was put in, it looks as new today as it did 3,000, 4,000 years ago, however old King Tut is. And it's because gold is forever, you know, and so it's easy to understand. It's also scarce. So it's easy to understand why that was an early medium of exchange. But what it really did was to solve this number one use. It solved the barter problem. The barter problem basically is this. It has to involve a so-called double coincidence of warrants. That is, if I want to buy a horse, let's say, and I'm kind of going back with old examples because these are pre-market economy transactions. I want to buy a horse and all I've got is chickens. Then I'm going to find somebody who happens to want chickens, who happens, that's where the double coincidence comes in, to have the horse that I want to have. In fact, it's actually multiple coincidences because it's not just a horse, but the horse that I want, and at the right exchange value. Then I'm going to have the number of chickens and the right amount of chickens that this person happens to want. The person who has the horse happens to also want the chickens that I have. So it's really, really difficult to engage in barter transactions. And by the way, I don't know if there's a standard for how many chickens equal one horse, or if there ever has been a standard for how many chickens equal one horse, or whatever the relationship is. I suppose it probably was some rule of thumb in pre-monetary days, What I suspect why feudalism happened in the first place, where you had feudal landholders who were, I guess, maybe a little more than gangsters, really. Maybe that's probably a little bit harsh, but they were military characters. They were very well armed and had a lot of men around them to support their efforts. But they extracted labor from people, and I suspect that labor was really one of the first means of exchange. That I perform labor and I get a portion of the output, and that's how I make my living. So labor was probably the first actual medium of exchange, because we all know what labor does and what it can do. It's just a matter of arranging that, and when one person gets multiple different labors that they can, kinds of labor they can do. Whereas chickens are going to be always chickens and a horse is always going to be a horse. People can do other particular things. So it's much more adaptable to transactions. But what money does is simply make it easy. If I want to go buy a humidifier from Costco, I simply go and buy a humidifier. I give them money, they give me the humidifier. If I don't like the price, I suppose I could try to negotiate a better deal, but we've talked a bit about this in this class, that we don't really have a culture here where we're used to negotiating the prices on everyday items. We just really don't. It's mostly limited when it comes to consumer demand. Houses and cars are about the only thing that people negotiate for. And because we don't negotiate for very much, there's a lot of economic research that shows that most consumers are probably not very good at negotiating. And it's not their fault, just that they don't have the muscle memory and the experience in order to do it. A lot of negotiation happens on much bigger ticket items. And in the business world, it's very common to negotiate the value of things back and forth, even including barter transactions, which are much more common today in the business to business world, particularly in real estate, where somebody says, I have 5 acres at Ventura and Paseo that I'll exchange for 500 acres on the Rio Puerco, and that'll be considered an even trade, and or whatever. I mean, whatever the ratio is, but you kind of get the idea that it does exist. But for everyday transactions, we need something that will make its way through the economy very quickly. And if I want to buy a humidifier, I'll pay $50 for a humidifier. If I think $50 is too much, maybe I go somewhere else and I get it for $40, and I buy it there. Maybe I go online and I'll buy it for $35. Whatever. I can choose to make the purchase wherever I like, but I'll still pay in the same medium of exchange. Costco doesn't want my labor from me. They don't want anything else. They don't want gallons of gas out of my car in order to pay for the humidifier. They just want to be paid in money. So that's what really facilitates transactions. That's why money is indispensable, and why there's so much effort to prop up the money supply, because it fuels the economy. In fact, we call it liquidity. And coming back to all these innumerable automotive metaphors, it's sort of the oil that sort of lubricates the economy. That and credit, and we'll get to the credit piece of this a bit later. Together, money and credit equals what we call liquidity. And we'll talk about that a bit. If you want to write that down, I can. Money plus credit equals liquidity. And liquidity is what lubricates the economy. Money plus credit equals liquidity. So you've heard this term liquidity before. Liquidity basically is this movement of cash, but it may not. But what makes credit different is that it's cash that you don't have, or whoever you is don't have immediately have. You borrow it from somebody else, but it becomes money as soon as you borrow it from somebody else. In fact, one of the processes of money creation is as the result of the borrowing function, and it becomes liquidity. Oh no, I didn't. I just didn't write the U. Equals liquidity, and this is what sort of fuels and greases the economy to keep it going. When you've got breakdowns in the monetary system, you've got a breakdown in the quote unquote real economy. And there's a reason why we spent so much time early in the semester doing the circular flow model, is because it graphically sort of lays out for everybody how the economy really functions in terms of reciprocal actions. Those red arrows of goods and labor go one way, and then the money flow of spending and wages go in the other direction. And the value of the goods and labor are equivalent to the spending and wages that compensate for those particular goods and labor. And so as a result, but how are they, where are those green arrows? How are they funded? They're in dollars, and this is where the dollars come from. And when there's a problem in the monetary side of things, there becomes an immediate problem on the so-called real economy, that is the physical flow. And the last time we had real issues macroeconomically was in 2008 when we had a number of financial failures, a lot of bank failures. And it really scared a lot of people. And, I know that, and it was sort of interesting as an economist and a former banker to look at it, because I know a lot of people were really concerned, and it was sort of a Chicken Little kind of thing, that the world, the sky is falling and whatnot. And I was pretty confident that we had the tools in order to repair the system, because when you think about it, this is not anything what this is not anything real. It's simply, it's the full faith and credit of the US government backing this up. And so it just took the government to sort of rebuild the financial system. And within a few weeks, within a few days, to be real honest with you, things began to get back to normal. So the stock market just took a gigantic hit. Everybody lost money. And then the people who weren't panicking, like the Warren Buffetts of the world, were buying stocks. He was old enough to remember the fact that these things happen periodically, these panics and freakouts, macro freakouts, and they can be rebuilt because the money supply, it's a money supply driven issue, or a money driven issue, and it just needs to be rebuilt by the feds. And it was, and things got back to normal relatively quickly. Okay, so it does work to our advantage to maintain it, which is why the government goes to great lengths to sort of maintain the the stability of the financial system. So medium exchange is the first in order to overcome the barter problem. Second is the store of value. So this is important. The relationship between the first and second is important because it's going to form its way in terms of the division of the money supply, that is the stock of money that exists, and the demand for money. You might think demand for money, what are we talking about demand for money? Isn't the demand for money infinite? And the answer is no, because we're talking about demand for money as money. I think when people talk about my demand for money is infinite, that you can never have enough, I think what they're really saying is you can never have enough wealth. I think that's really what they're getting at, because money in itself is often used to transfer itself into wealth, whether it's real estate or financial investments like bonds and stocks and whatever, or businesses or whatever, that sort of thing. So the demand for money as money is not infinite. We will see that played out in various ways. But the relationship between medium exchange and store of value is important because it represents the two divisions of uses, but also the two divisions of the supply of money and the demand for money. So what is the second one, the store of value? It basically means that money can be spent now or saved to spend later. Save to spend later. So I can spend it now or I can save it. And if it's a store of value, I can simply keep it as money. Now, and I want to be clear here that we talk about money as a store of value. We're talking about money as money, not money as real estate. That is, if I have saved $100,000 over my lifetime and I want to convert it to rental properties or whatever, that is not money as money. That's money as real estate now. So you no longer have the money, now you have the real estate. You give somebody the money, they give you the real estate ownership. This is money as money when we talk about store of value. That I can either spend it now, whatever I've got in my pocket, I can spend it now, or I can hold on to it as a store of value, and it will be there for whenever I choose to spend it. Whether I deposit it in a bank or wherever, or I just simply keep it in my pocket or carry it around with me or whatever, okay? So it's a store of value, and it can be preserved in its present form. In fact, if it's converted to a different form, then it no longer becomes money. Somebody else has the money. And we'll talk about this idea of money changing hands, because you might think that a $21 trillion economy needs $21 trillion in cash, but it doesn't. And the reason why is because the same dollars get recycled over and over again, particularly on the first issue, that is medium exchange, where the dollars in my pocket today are going to end up in the cash register at Walgreens tonight, or the cash register at Albertsons, and then on deposit tomorrow morning at Bank of America, and then loaned out to somebody on a credit card loan on Friday or whatever. So it moves. Money has velocity. It moves. It changes hands, as we know. So, but what I'm saying is we don't need $21 trillion to fund $21 trillion in GDP. In fact, that would be hugely inflationary because money is recycled. It's a recyclable thing. And by the way, money is money. It's what we call fungible. That is the idea that a dollar in my pocket is worth the same as the dollar in your pocket. It's exactly the same. Even if you've got a dollar bill, it's all banged up and broken up and run over by a car, it's still worth $1. And where it's all banged up, you might want to get rid of that. And at some point, when it makes its way to a bank a bank is just going to send that to the Federal Reserve and say, this money is done. And the Federal Reserve say, yep, you're right. We'll credit you, bank, we'll credit your account $1. Or however many dollars they send it at one time. Okay. So the two main uses are medium exchange and store of value. And the third is as a unit of account. That is, it serves as some sort of what we call a yardstick of value. That is, it's the way we measure value throughout the economy. It's the way we measure the value of labor. It's the way we measure the value of goods. And that it is a reality, it's a truism throughout everywhere in economics and finance and accounting, that what is the value of anything? We say it's the value is the price that someone's willing to pay for it, expressed in, you got it, dollars, right? So what is the value? So if you think about it, and I know a lot of times people will look at the salaries of actors and baseball players and think, wow, why are they worth that much? And in fact, if you look at baseball salaries, I think we're now starting to see probably what's going to be the peak in baseball salaries. I don't know if I talked about this in this class or what, but it looks like that people don't watch baseball that much anymore. It's just not as big of a deal. And it looks like those salaries are probably going to peak because I think there's recognition that they're not really delivering the kind of value. And by the way, when I record a postseason game, a baseball game, on a DVR, I set it for 6 hours because it just takes forever. There's a reason why people don't watch baseball. It just takes too darn long. So you get the idea that the value is going to come down because people are recognizing it's maybe not worth it to them. We have substitutes throughout the economy. So, but that's just one example. I'm not picking on baseball. I'm just simply saying the value of anything is what somebody's willing to pay for it. So if somebody's willing to pay $25 million a year for somebody to do what they do, then obviously they think that person is worth the value. Or if I think the value of the humidifier is worth $50, I'll pay it. If I think it's not, I won't pay it. And if everybody else agrees $50 is too high, and I don't really know, it's been a while since I've bought a humidifier. I could be way off. It could be $100. I have no idea. But if everybody else says $50 is too high, you've got to be kidding. Then the price will probably come down, even if it's below the cost of acquiring it, just to get rid of it. Because if people aren't willing to pay for it and it costs a lot to bring it to market, then that good simply goes away unless demand changes at some point, and that is in this case not necessarily likely. So this is the way we count for everything, is in terms of dollars. So and it's also got some sort of perverse implications as well, because it's the way we settle the value of lawsuits is in terms of dollars, particularly. And I know it gets a little bit grotesque when you talk about the idea of if you've ever seen like a liability policy or an accidental death or dismemberment policy, it'll be very specific as to what the insurance company will pay you if you lose a foot or 2 feet or 1 leg and 1 foot, or the leg and foot. Well, the foot is attached to the leg, but I mean, I know it's already sounding a little bit gross here, but it's the way, it's very, very specific. And it's the way that you are compensated for the loss of something, which is what insurance is essentially there to do, to compensate you financially for the loss. You can't repair emotional damage or any other thing, but just the financial loss. So it's how we value everything, the value of profits, the value of assets. And we'll talk more about assets and liabilities here a bit later, okay? All right, so having said that we've got really these divisions within the economy of the idea of, particularly the first two, but medium exchange and store of value, this kind of leads us then to the money supply. U.S. money supply, or any money supply. And the money supply measure is usually measured with a capital M and then some number behind it. And what's really interesting about this is that we've got two measures of money supply, M1 and M2, and one is accumulation, one captures all of the other. So M1 basically is the most liquid. Now remember what liquidity is. It's basically that liquid sort of grease that runs the economy. It is money primarily, right? And that is money you can get to right away. It's not really credit. And I think that, sometimes you might have the question is, are credit cards money? Credit cards themselves aren't money, but they can create new money every time you use a credit card. Because every time you use, and I'm not talking about a debit card, I'm talking about a credit card. Because a credit card, if you use a credit card like a MasterCard or Visa, I know they have the same labels on debit cards. I get that. But we're talking about credit cards. That is brand new money. It's a bank loan to you buy whatever you're buying on a credit card. And so credit cards are not money, but they can create money. They can become M1, and it's most liquid. Oops, most liquid, not most liquidity. It's the most liquid, so it becomes cash right away. So what goes into this category of M1? It's cash itself, which is about as liquid as you get. It's coin, it's checking deposits. In other words, it's primarily, when we talk about this, it's actually not so much cash and coin, really, but what are called transaction accounts. Transaction accounts. These are deposit accounts at depository institutions. Okay, and why don't I just say banks, because it's a bigger subject than just banks. Depository institutions include banks, savings and loans, which today the difference between banks and savings and loans are almost invisible. At one time, they were much different in the sense that banks used to be mostly about gathering M1, very liquid deposits, and serving business borrowers, whereas savings and loans were mostly about saving less liquid deposits that we'll talk about M2 here in a minute, and then making longer term loans mostly to people, ordinary individuals. Today, those differences are sort of blurred. Transaction accounts, which can be called checking accounts, or in the credit unions are another example. They call those share draft accounts because the credit unions are non-for-profit. So it's like a mutual insurance company where you're a theoretical owner of the company. And so if you have a bank account at a credit union, you're a theoretical owner. And so your account is called a share account that you write drafts off of. And all checks are forms of drafts. All drafts are simply liquid orders or written orders to pay. Written orders to pay, whether they're done electronically or not. But if they're in paper form, they've got to be signed somehow. Oftentimes business checks use a facsimile signature so that the treasurer of the company doesn't have to write 5,000 payroll checks or sign 5,000 payroll checks. But transaction accounts fit into this. Also, other kinds of things that are spendable right away in order to be used as immediate exchange right away. There's things like money orders. So what are money orders? Money orders historically have been used where transactions are done by mail, where people don't want to mail money for obvious reasons. And the people getting it don't have a way to deal with large volumes of cash coming in because it has to be stored and accounted and usually counted by two people, and bank deposit and all that. Money orders can just all be collected and deposited at once. It's oftentimes, money orders, I guess, historically were used, particularly for those who didn't have bank accounts, so-called unbanked part of the population. People didn't have bank accounts because they didn't want bank accounts or they couldn't get bank accounts. It used to be about 30 years ago or so, banks started using a system where if you had a bad experience with a transaction account, you went on sort of a database and it was hard to open one elsewhere because banks sort of had your number that you really couldn't handle a checking account, or bad checks were overdrawn a lot, and that's a problem. So being overdrawn is not a good situation. So that's where your balance is negative. So and that becomes a big loan to you. But that's real liquidity because you will have spent that money somewhere in the economy. Somebody else has now got that. So money orders are one. You can buy them at banks usually. The post office is long issued money orders, and so they're a form of money. Essentially, they're a form of M1 because they're just convertible immediately to cash by whoever can convert them. Also, traveler's checks are an example. And traveler's checks are mostly going away, mostly being replaced by forms of plastic and or electronic transactions. But traveler's checks used to be a really big deal when I was a kid, even as I was first, coming into adulthood, where if you left home, you're on the road and you didn't want to carry a lot of cash because if you lost it, then you were 1,000 miles away and you couldn't get more money right away without having somebody wire you money, which was not easy and cheap or anything like that. I mean, I guess it was somewhat easy, but it was inconvenient. But if you lost traveler's checks, you could just simply call American Express or whomever, and they would replace it pretty much right away. And all you had to have is your serial numbers. They would replace them. If you didn't even have that, they were. But today it's mostly plastic, and a lot of people who travel now just simply book hotel and cars and airfare ahead of time, and then all you do is share your credit card, and it's no big deal. And in fact, you can travel around the world a lot of times using credit and debit cards, and it'll just convert dollars to that local currency, and they usually take a pretty good fee out for doing that, but nonetheless, it will serve as M1. Okay, so it's money, and the key thing here too is that it's in non-interest bearing form, and that's an important characteristic. It tends to be non-interest bearing form, and I know that there are checking accounts that do pay interest. I get that, but they didn't used to pay interest. That only came around about really when interest rates were super high back in the late 70s, early 80s. And then some people were saying, look, I've got $10,000 on deposit at your bank, and maybe I've got too much in my checking account. That's true. But I'm also gonna, if I put money in the savings account or something, I can't get to it that easily. I can't write a check off of it. So really customers were demanding to be paid interest. And so these accounts called money market checking accounts, the actual name for it is called the NOW account, negotiable order of withdrawal is the name of the account. That's a interest-bearing checking account. But those are not particularly popular today because interest rates everywhere are so low, particularly even on the M2 variety of savings accounts, to the point where banks are really sort of clicking their heels in joy because rates are coming back up. And so there is some feeling that people who really want to get returns on their money that they really couldn't in bank deposits for the last 20 years or more, or maybe now going to start coming back to banks where it's much, much safer than the stock market because people have, one of the reasons why the stock market has just been roaring through the roof in the last 20 years is because of the fact that I think one reason why is people need to get a return on their money and banks weren't offering it because rates were just so extremely low. I mean, if you were being paid 0.5% on your money and inflation was running at 2% per year, you were actually losing ground in terms of purchasing power. And so if you had any amount of money at all, you probably didn't want to keep it in a bank. And so you were sort of forced to take riskier choices, which is, I think, not necessarily a good thing. And so this is why the Federal Reserve about 4 years ago was trying to re-engineer interest rates to try to get back to what they call normalization. That these super low rates that began after the 9/11 terrorist attacks 21 years ago were not sustainable. But then the COVID pandemic hit, so they ended up lowering rates again. Just last week, I believe it was, the Federal Reserve embarked on what they think is going to be another 11 increases in the interest rate between now and the end of next year. 0.25% at a time, so that'll be 12 altogether. That's about a 3% increase. And when we say the interest rate, I think I've talked about this before in class, but it's often confusing to people because people will often say, what do you mean by the interest rate? There are all kinds of interest rates, rates on student loans, car loans, credit cards, savings accounts, they're all over the place. And that is true, but when we're talking about the macroeconomy and a base rate, it's usually some rate that we'll fixate on, and the rate is usually the Fed fund, what's called the Fed funds rate. All that is a bank-to-bank lending rate overnight, where banks lend each other money. We'll talk more about that in chapter 15. That's really what it is. It's the rate. It's super low right now. It's 0.5%, and but every rate in the economy is theoretically tied to that very base rate, and it goes up from there. With the exception of some bank deposits, which are extremely low. I think my savings account for years and years paid 0.01%, which basically rounds to zero. And every now and then we get like a penny of interest. Now, primarily, I just didn't keep very much money in it because it didn't pay anything, but also the rate was exceptionally low. So that's M1. The next part of the money supply is M2, which is basically this. It includes all of M1 plus less liquid forms of money. It's less liquid forms. So if this is most liquid forms of money, maybe I should sort of round that out a little bit. This is less liquid forms of money, and it includes things like time deposits. This would be savings accounts, certificates of deposits, savings certificates of various kinds, IRA accounts where you're locked in at a specific maturity that is a time frame. Some of these are what's called open accounts, like savings accounts where you can go in tomorrow and make a deposit, they go back in on Friday, take some of it back out. Some are locked into a time frame, like a certificate of deposit. But the thing about M2 is it's an accumulation. All of all of M1 is subsumed within M2. So and M1 is just a small portion of what is M2, but M1 is a subset of M2, basically. Now, by the way, you might think, well, that's kind of odd, but it really is, it's accumulated. So M2 is bigger than M1, not just because the non-M1 part of it's bigger, but because it includes all of M1 in the first place. So M1 is a subset of M2, and M2 obviously includes all of M1. Now, what's really interesting is that years ago, in the not too distant past, there was an M1, an M2, an M3, and M4, which sort of further subdivided the world that we now know as M2. And it was divided into all kinds of different things, all kinds of different forms of money, even things which had monetary uses, but really weren't money as money, but were so close to money that they might as well have been, like money market funds, which were sort of an element of M4. A money market fund is a non-cash kind of thing, but it's so liquid you can get at it right away. You can even write checks off of it and pay things. But it's really a form of investment, really, that invests in very short-term securities, mostly government securities and some bank securities and things like that, or bank issues, things like that. So there's a lot that goes into it, and you can read for yourself, but primarily what I put on the slide package was primarily time deposits. And the fact about this is that it tends to be interest bearing. The non-M1 portion, that is, of M2 tends to be interest bearing. That is, it pays some interest. Now, not very much interest, and it hasn't for quite some time, but it is designed to pay interest. All of M2 that is not part of it, that is not including M1, will pay interest, even if it's 0.01%, which rounds to zero essentially. But it was a way to still maintain the definition of time deposit. And by the way, banks would rather do that because there are reserve requirements that banks have to meet for both time deposits and transaction accounts. That is, they've got to set money aside at the Federal Reserve, which is our nation's central bank, and we will talk much more about the Federal Reserve on Thursday. But it's the idea that if you put $1,000 on deposit, see you're going to pay check, it's $1,000, you put it into your checking account. I think it's 10% is the reserve requirement. $100 that goes right away off to the Federal Reserve. It can't be loaned, it can't be invested, it's there. It's sort of, and it traditionally and historically was there to prevent bank runs. If people made a run on the bank, that you could tap into that to pay people back their money. But today it's mostly used as a monetary control measure. The Federal Reserve can raise it or lower it if they want to increase the money in play in the economy or not in play in the economy. And by the way, there's a great discussion in your text about bank runs. And what's really interesting is that I talked about a few minutes ago that if you had $1 million on deposit at Wells Fargo and you went to get it out, they couldn't give it to you. Well, that's mostly just a sort of an operational feature of bank branches. They usually don't have $1 million. You know, I even managed some very big urban branches in downtown areas that had nowhere near $1 million on deposit. We had big cash vaults in very secure remote locations nobody knew about, sort of a double secret place that did have millions and millions and millions of dollars in cash. But it was usually there on its way back to the Federal Reserve by armored car, that sort of thing, where it be credited back to that bank's account there. But the bigger issue with bank runs is that if everybody wanted their money out of a bank, the bank couldn't do it and they would fold right away. And so I know my first day in banking, we had a sort of a parade of executives talking to us, or those of us new management trainees. And one of them said that a bank is a house of cards. And I thought, okay, whatever. But it really is. I mean, a bank is really a house of cards. If everybody wanted their money out at the same time, the bank could not do it. There's no way. It's been loaned out. It's in investments. It just doesn't exist. The money is not there sitting in the vault for you. And so if people do panic and make a run on the bank will probably fail. We have seen cases in the last even couple, 3 decades where banks, in a rare instance, it doesn't happen very often anymore, will make a run on the bank to get their money out, even despite the fact that there is deposit insurance and has been for the last 90-some years on bank deposits. But it cuts off at a certain amount. So if you've got a lot in there, you can understand why people would want to get their money out. And the best example in movies is the Jimmy Stewart movie, It's a Wonderful Life, where everybody wants their money out of his bank. It's actually savings and loan. And he can't do it. He's explaining your money's not there. It's in Fred's house across the street and whatnot. which a banker shouldn't be talking about who's got loans with him, but it's a movie, okay? So, but it was an example of the fact that the bank was about to fail because everybody was panicking. Jimmy Stewart was trying to tell everybody not to panic, which was interesting because it really showed the fact that people do panic. The financial panics do happen. Bad things happen because bad decisions get made. And this is why bankers and their regulators go to great lengths to make people confident in the banking system. Why banks build big granite buildings and have steel vaults is because they want people to at least have the notion that it is a safe and secure place. So in reality, a bank is a house of cards, but it's propped up with regulation. Having said that, though, the regulation is maybe no more sturdy than popsicle sticks because you can knock those down if you don't comply with regulations. And we saw banks take a lot of risks in the early 2000s with mortgage lending. They got crazy, ignored some of the things they shouldn't have been doing, or ignored some of the guardrails that were there to prevent them from hurting themselves, but they did it. And I thought the best explanation for why banks got in trouble, and it culminated in the 2008 bank failures, was JP Morgan's CEO, Jamie Dimon, who said, the banks do it because it's a competitive nature. If my competitor is going to take risks doing something, making loans to people with no down payments, I'm going to make loans to people with no down payments, or I lose business. So I've got to do it. As long as it's legal to do, and it was, then I've got to do it because of a competitive nature. Otherwise, I lose customers. So how we save banks from themselves is we regulate them tremendously. And I'm not going to get really as much into the regulation piece of this as what the text does. I think it's if you're in bank regulation, that's really a 300-level course. It's called Money in Banking. Usually, it's a university course. Usually, I don't know whether it's usually taught by the econ department. I've taught it before, but not here because it's 300 level. It's usually taken by econ majors and finance majors. That's about it usually. Unless I guess you can take it as elected, but it gets much more into the bank regulation. And I'd rather focus on economics than the regulatory piece of this. Even though I've got a bit of it in there because there are times that we really should talk about bank regulation. Okay. All right. So questions for me about anything so far as to what we've covered with regard to the money supply and what it's all about. Well, we'll get into some of the graphic pieces of this. And again, I can just keep checking the chat box there, and if you do have questions, feel free to chime in. And this way, you don't have to speak if you don't want to, but you can certainly give me a question, and I'm more than glad to answer them. So let's talk a bit about money creation. So what's interesting about money creation is that there are really two main forms of where money comes from. And this is kind of, to me, it's kind of mind-blowing because I never really thought about it until I took econ the first time. And I learned that a lot of money creation is simply the act of banks making loans, or more specifically, depository institutions making loans, where those loans end up somewhere in the banking system, that is in the financial system, and therefore at play in the economy. And every time you take out a new loan, it is actually new money being created. At the same time, every time you repay a loan, or a part of a loan, that it's actually taking money out of the economy. So it works in reverse in that same way, which is a little bit less discussed in the book, but that's one way. The other way is that the Federal Reserve can simply create money out of thin air, and we'll talk a bit about that. That's a little bit more down the road as we talk more about the Federal Reserve. And I know that I keep talking about the Federal Reserve. It's almost impossible to talk about finance without getting to the Federal Reserve because they are such an integral role. They play such an integral role in both the financial part of the economy, as well as, frankly, the so-called real economy. That is the red and green arrows, both on the circular flow model. Okay, so we talk about money creation. What is it really? It's a product of banks lending feature, and as a result, new loans become new money. So we're talking about a balance sheet, and we're going to use a theoretical account called a T account. So a T account basically looks like this. For those of you who have any amount of accounting at all, if you've taken an accounting course, you'll recognize T accounts because T accounts basically separate, in the accounting world, it's mostly separating debits from credits. we're not going to get that sophisticated here. Instead, we're just simply going to put assets on one side and liabilities on the other. And it's called a balance sheet in the sense that assets and liabilities they have to balance each other. Presumably, though, assets are greater than liabilities. We hope that there is. So to balance that, there's an account called equity, equity of owners, which is used to balance it out. So the basic accounting equation is, this pen is out of ink here, isn't it? So running out of ink all over the place here. So the basic accounting equation everywhere in accounting is assets, which are defined as things which are owned, right? Things which are owned by whoever the owner is. In this case, we're talking about a bank's balance sheet, which lays out what is owned and what is owed. So liabilities, so it equals liabilities. That is what is owed plus equity or capital or whatever you want to talk about. We'll just simply say equity here, owner's equity. So assets, things which are owned, liabilities, things which are owed. And I know that in the accounting world, having taken lots of accounting myself, assets are, there's a formal definition that says assets are those things which are owed, which are as a result of past transactions and which have future service value. That's a key element. And to be an asset, you've got to have future service value. If it's got no future value, it probably should be written down or off and taken off of the books. That is the balance sheet. A liability is anything which is owed, incurred as a result of past transactions, and which represent a claim on assets at some point in the future. Okay? Well, when we're talking about a bank, and then equity is to balance this. The reason it's called a balance sheet is that this side must equal this side. So if this is side A and this is side B, A must equal B. Then the value over here, whatever it is, must equal the same value over there. Always, 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 always. Otherwise, it doesn't balance. And the only way to get it to balance is to have this account called equity or capital or owner's equity, whatever, which is simply the owner's ownership of assets that takes away the creditor's ownership of assets. It's not really ownership, but it's a claim to assets. So when we're talking about assets of a bank, what are we talking about here? We're talking primarily about loans, which is an asset. It's things which are created as a result of past transactions, which have future service value. Also, loans and investments. And banks will either lend money or they'll invest it. So when you put money for deposit in a bank, that bank will take a turn around and do things with that. And and we all know that bank deposits fund bank loans. That is true. But before they become bank loans, actually, you know what? Before I do this, I probably ought to make loans and investments here. But then there's one that comes really before that that's important for our understanding, and that is reserves. So what happens is when you make a bank deposit, let's say you take that $1,000 paycheck and make a deposit, it becomes a liability to the bank. And you hope they consider it a liability because a liability is things which are owed and there was a claim on future assets. That is, you want to get that $1,000 back at some point, right? Otherwise, you wouldn't take it to a bank if you thought you were going to lose it. So you're going to take it there. So a liability, a deposit is a liability. So and it's just reversed as, so your personal balance sheet differs exactly the opposite from a bank's balance sheet. Your bank deposit is your asset, and a loan to a bank from you, the bank is loan to you, is your liability. Whereas with a bank, your bank deposit becomes their liability back to you, and the loan that they've made to you is an asset to them. But this is the reflective nature of the economy. So all accounts in the economy must be balanced theoretically because of this this sort of symmetry that my deposit is your liability, my loan, which is my liability, is your asset, that sort of thing. Okay. And so what are reserves then? This is the most interesting part of this. So when you make that bank deposit, it first becomes a reserve, and that's basically just it's just cash that the bank has. You make a $1,000 bank deposit of your paycheck, and it goes into the reserves first. It's just cash that a bank can do whatever it wants to do with it because it may not have borrowers to handle all these deposits. And so they're going to find a place, something to do with it. So they may not have borrowers, and so maybe they make it short-term investments in treasury securities, or maybe they loan it to other banks, which is very common. I know that when I was in banking in the early 90s, we had really, and I didn't find this out until later after I moved into upper management, that we weren't really making too many loans, and it was very hard to get loans approved. And it turns out the reason why was because at that time we were preferring to loan money to other banks because that rate, the interbank loan rate, the Fed funds rate, was so high. I think it was like 9%. So we were getting like 9% on our money from another bank. And we, of course, in those days, people thought banks were as good as gold, basically. This is before the financial crisis of 2007, 2008. But we would rather lend money to banks than to ordinary people. And of course, we didn't advertise that fact. That would not be very good advertising, would it? But you get the idea that these reserves have got to go somewhere so they can become loans or they can become investments in something else. And these loans can be loans for whatever. Now the investments the banks are limited to what they can do in terms of investments. The bank themselves, banks have actually, since about the late 60s, when the Bank Holding Company Act went into force, banks have formed corporations to own themselves. And so if you bank with Bank of America is actually owned by Bank of America Corporation, which is their holding company that's got other kinds of things. And so if a bank wants to do some riskier things like trade in options or do things like swaps, these complicated financial transactions that most ordinary people don't do, they probably don't do it within the bank itself. They probably have a unit within their holding company that does do that. And even for very specialized areas like mortgage lending and even credit card lending in some cases, they have separate companies within the bank holding company structure. This is just the bank itself, the core bank, where most of the assets are loans, reserves, loans, and investments, and most of the liabilities are bank deposits. Okay, so this is an important thing to know. And then this is simply capital. That's all it really is. And it's a residual. That's all it really is. It's basically the residual, which is basically the difference between assets and liabilities. That's all it really is. Assets minus liabilities. So presumably the value of assets should exceed the value of liabilities. So you have a positive amount of capital. And what's really interesting is that banks traditionally have, compared to industrial companies and retailers and other forms, this equity count is in percentage terms very, very low usually. Oftentimes in single digits percentage-wise. That is, if you have $1 million in assets, you might only have something like 80,000 in equity. It's mostly because of the fact that banks are really surviving on borrowed money. That's where they're surviving. That's why if you make a run on the bank and it's all gone here, it's not there. It's not here to pay out. It's out the door. But banks survive on deposits, and banks sort of like the very low interest rate environment for quite some time because of the fact that they can make any kind of interest rate that they earn on loans was going to be greater than what they paid on deposits by far. But now I think they're looking to get more deposits because rates are going up, and so they'll just adjust their loan rates upward, and which means that fewer people are going to qualify. And that's really part of the purpose of the Federal Reserve raising interest rates. And we're going to talk much more about interest rates and what that is. But before we do that, though, let's just give one definition here of what the interest rate is. And I don't know if I have talked about this before, but it is simply this. We talk about the interest rate. There's interest rates that are earned on loans, interest rates that are sometimes paid on deposits. Primarily this portion is interest bearing. This tends not to be, even though there are some accounts that do pay some, but very little. The interest rate is what? Or let's define what interest is. And I think I've talked about this before, but it is the rental cost of money. That sounds like a pretty wonky definition because we all think we know what interest is, but it's the rental cost of money. And in fact, that's what's happening here. When you make a bank deposit, you are actually leasing your money to a bank and they are renting it from you for a period of time. And if they pay you a rate of interest, it's based upon that rental cost of money that is always expressed as a percentage. Always expressed as a percentage. And it's an annual percentage. Every interest rate is an annual percentage. It's not like the Sopranos where they loan you money at 2% per week or something like that. It's not a loan sharking operation. All interest rates expressed in the world of legitimate finance, which loan sharking is not, is expressed in annual interest rates. unless stated otherwise, but that's usually almost never the case. So it's stated annually, and for consumer transactions, almost always. And there are so many disclosures about how banks disclose interest rates to ordinary consumers. And so theoretically, the rate earned on loans and investments should exceed the rate paid on deposits. And that's where banks make their money, which is what funds their capital and funds their ability to pay employees and to do all the kinds of things that they do throughout the community and to pay dividends to shareholders who own stock in the broader company itself. Okay, so this is the bank balance sheet. This is the interest rate. When we talk about the interest rate, we're usually going to refer to the interest rate as some I. And we'll talk about the connection between interest rate. We've talked, I think, a little bit about this before, particularly in relation to investment, that the big I in the expenditures approach to computing GDP, C plus I plus G. Well, it's the same I here. Okay. And when we talk about, again, getting over this potential roadblock of what do you mean by the interest rate, it's usually the Fed funds rate that we're talking about. And from there, all rates in the economy tend to flow upward. And that's really sort of a hallmark of finance. I know if you take a corporate finance class, they'll probably say that the lowest rate that everything works its way off of is the safest rate and lowest maturity of a treasury security, like a 30-day treasury bill, something like that. That rate is probably pretty close to the Fed funds rate. So, but for bank rates, Fed funds is probably more applicable than the treasury rate itself. That is borrowings by the federal government and the rate the federal government pays to borrow money. And when does the government borrow money? Well, they borrow money. We'll see more next week why that's the case. So when we come back on Thursday, we'll do some sample transactions for a bank to show the process of money creation. Then we'll talk a bit about the demand for money, talk a bit about the relationship between banks and bonds, or money and bonds. That's an important characteristic. And then we'll talk about the Federal Reserve and how they engage in all the things that they do, which is a lot of stuff that they cover. And hopefully, and what we don't get done on Thursday, I suspect and I think I told you earlier, we'll probably carry that over into next week. So are there questions for me about anything we've talked about today with regard to money and banking? Okay, well, have a great rest of your day. I'm going to post this as a YouTube video, and I'll see you all next time. Sort of.